Thanks for joining us at this Magellan update. Today I'm speaking with Hamish Douglass, the CEO and lead portfolio manager, specifically on the Brexit issue. Hamish, the Brexit vote, does it increase the systemic risk, and does it change your cautiousness on markets generally?
We don't think it really changes the systemic risk out there at the moment, this Brexit vote. We've got a long way to go to know what's going to happen in the UK from this vote, but we're very unlikely to see a banking crisis. We're very unlikely to see a rerun of 2008 from this event. And if you actually look at markets, even though we've seen a lot of volatility, but if you go to the very important credit markets and you look at insurance costs and credit default swaps, there's been very modest movements in credit default swaps, which you would think are most exposed in periphery countries in Europe, like Spain and Italy. You would expect it to see, if there was a lot of systemic risk there, large blowouts in costs. There have been very modest increases in costs, and we actually think that is realistic that's occurring. If you look in insurance costs of European banks, they've gone up modestly. At the end of the day, credit costs have actually come down because sovereign bonds have been bid in with this market volatility. So we've seen a lot of volatility in equity markets, particularly in banking stocks in Europe, and I think with this uncertainty that's to be expected in equity markets. We've seen a lot of currency volatility, particularly in relation to the pound, but they don't necessarily signal that we've got a global systemic issue at hand. So at the end of the day, we don't believe we're going to see a financial crisis develop globally from this event. We're mindful of second order events and we're thinking about second order events, but in the first order events, systemic risks, and it really doesn't change our overall bearing. We have been cautious on markets. There is a lot of issues going on around the world at the moment. We're sitting at 15 or 16% in cash, and nothing has fundamentally changed our bearing over the last week with this vote.
And so what does Brexit mean for the UK?
Well, for the UK, obviously, it's far more complicated. I don't think we're going to know for quite a number of years what this actually means for the UK. And as we think about this, we really think we put the scenarios into three different categories. We think there's a 25% probability the UK actually doesn't exit the European Union. And that may seem extraordinary, but there's a lot of water to go under this bridge. It is not a binding referendum. And at the end of the day, they've been asked a very simplistic question. I think we're going to get a lot of pressure, particularly out of Scotland and Ireland. I think they're going to probably launch a constitutional challenge of whether or not their parliaments have the right, that they have to be asked whether or not Article 50 can be triggered by the British government. We don't know what the answer of that, and that may well have a High Court challenge. If that doesn't require their votes, they may well put up a case to say, well, if you push a Brexit decision to exit the EU, we are going to put up simultaneous referendums to leave the UK. That could well trigger back in Westminster saying, well, this exactly wasn't the question we asked the people to leave, which could trigger another referendum. If the question is, do you want to leave and have the UK broken up, was probably a very different question to what they thought they were voting on. As I say, 25% probability, this never happens. The most likely case, and what we put as the 50% probability here, is ultimately they do trigger Article 50 and they start a process of negotiation. And where they ultimately end in their destination is effectively part of the single market in Europe. And there are 4 nations that are part of the single market that are not part of the European Union. And they're Switzerland, they're Norway, Iceland and Liechtenstein. And all of those countries have effectively ceded to a certain amount of European control at the end of the day. And very importantly, they've agreed to the free movement of labour within the European Union and within those 4 countries in order to be part of a free trade zone within Europe. I would say at the end of the day, it is most likely that the UK ends up, if they do exit, ends up with an agreement and they remain part of the single market, but they'll have to contribute to the European Union budget and they'll have to cede to free movement of labour within Europe. That isn't exactly the promise the Leave campaign put forward, but at the end of the day they have to choose whether or not 50% of their exports going to Europe, they want to be part of the single market. Of course, the Leave campaign promised you can be part of the single market and get all these other benefits, such as total control of your borders. Utopia doesn't exist, and any free trade agreement with the UK will require the agreement of effectively all other members of the EU. There are 27 other members of the EU and they will require parliamentary votes. I think there is no chance that the UK could get utopia, so they will end up, most likely if they choose to exit, in an agreement that isn't that dissimilar to where they are at the moment. You could argue maybe they're better off or worse off. They're still going to be subject to many EU laws, not all of them they'll be subject to at the moment, but they won't have any say or influence over those laws outside of the EU, but they may not be quite as constrained. The 25% probability for the UK is that they choose to exit and they're saying is we want total control. Ultimately, in that answer, I think they're outside the single market. That is a bad outcome at the end of the day. But even the Leave campaigners are not actually proponents of that outcome. So I think the probabilities of that are fairly low. We're not going to know this for a long time. So a 75% probability in the medium to long term is either this doesn't happen or they remain inside the single market, and therefore the long-term economic consequences in all probabilities are not that negative for the UK in the long term. There's a 25% probability that they decide to commit suicide here, but the utopian answer is we'll be in the single market and have total freedom and total choice. I would discount that almost to zero as a likely outcome here. Of course, what we're in at the moment is a great period of uncertainty for the UK. We're in a period where it's very likely that investment is going to come to a grinding halt in the UK because people aren't going to know for a very extended period of time what the way forward in the UK, even though in all likelihood it's not going to be a disaster in the long term. But with this uncertainty, less investment, probably more saving, lower growth in the UK. For the short term, I think people are right. The economy is going to slow down. I don't think we're going to have a major financial crisis in the UK or a very deep recession. But I think the consequences for the foreseeable future from an economic scenario are fairly negative for the UK.
And so does the Brexit actually materially increase the risk of an EU breakup?
Well, that's a very good question of whether or not it increases the risk of an EU breakup. I think we need to start to distinguish between the European Union, where there are 28 members, and the Eurozone, which is a subset of the European Union that has 18 members. The real risk, systemic risk for the world, would be a Eurozone member, a country who is part of the Union but their currency is the euro, exiting the Eurozone. There is no legal mechanism, there is no Article 50 for a Eurozone member to leave the Eurozone. If a country like Greece or Italy or France, and there are extreme right-wing parties in the Netherlands and in France at the moment, and even in Italy to some extent, who have put forward Frexits and Nexits to leave the European Union and the Eurozone, that would be an unmitigated disaster for the world. The implications for the financial system would be severe. The probability of a country leaving the Eurozone in the foreseeable future is very low. It is very low. There is no mechanism, and I would argue, given the volatility we've seen since this vote in the UK, I think the probabilities of people wanting to do that has actually decreased, not increased. So in a way, the UK has told to the rest of Europe, this is not a very sensible path. And of course, the UK was only a member of the EU. It wasn't part of the Eurozone. So the risks and the systemic risks were much lower. Imagine if a country in the Eurozone actually sought to exit. We can't ignore these right-wing political parties. We can't ignore the pressure the middle to lower classes have felt through globalisation and getting felt left out. A lot of this is a protest around immigration and globalisation at the end of the day. But given the uncertainty that's been caused by this, it may actually dampen some of the enthusiasm in the short term. So your question is, does it increase the probability of a breakup of the EU? No, I don't think it increases the probabilities of the major event of the Eurozone. I think that's actually reduced those. I think they're very low in any event. But would another country like Denmark want to exit and follow the UK through this process? Well, no one's going to know what the answer is for the UK for 2 to 3 years, in all likelihood. I don't think any other country is going to try and experiment when they have no idea what the consequences are. But it doesn't mean it's zero probability, but I think the probabilities are pretty low.
And Hamish, with regards to the portfolio, does it impact your views on UK exposures like Lloyds and Tesco?
Yeah, I think we need to distinguish between Lloyds and Tesco here. Our exposure to Tesco is really an exposure to the pound. They're a consumer staples retailer that's going through a turnaround. A slightly slowing UK economy is a slight negative, but it's a staple type retailer, so we're not overly concerned. Of course, with the pound devaluing, as a global investor, we're taking the cost of that pound devaluation. Tesco gets some of that back because they've got operations in Asia and also in Europe, and as the pound devaluations, the value of those foreign earnings become more valuable. It's only about a third of their business, so it's a smaller part of their business, so they have partly an offset there. So Tesco, outside of the translation effect we get on the pound, we're not overly concerned around Tesco. Lloyds is more pointed. I'm pleased we're not in RBS or Barclays or something, because they're facing passporting rights and things where they trade through the whole of Europe. Lloyds is really now a domestic small business and retail bank in the UK, very, very well positioned within that market. But if the economy slows down, there's going to be less lending. If they cut interest rates further, and there's a reasonably high probability that they will cut interest rates further, that will put further pressure on Lloyds' earnings in the near term. So the translation effect of the lower pound will take directly on Lloyds. And I think over the next 3 or 4 years, the earnings growth out of Lloyds is going to be lower than it would have otherwise been. But in the long term, I think in all likelihood, the UK is fine, and Lloyds is a very strong domestic bank, and of course its share price in reaction to this has come off materially. So we're not about to take any action, nor do we think there is capital or systemic risks attaching to Lloyds. We just think their earnings growth over the next few years, the outlook has dimmed from where we were a week ago.
And what does all this mean for global monetary policy?
At the end of the day, we don't think we've got a systemic issue, and that was where we started. But with this uncertainty going on around what does it mean, and we're not going to know that for quite a period of time out of the UK, I was trying to explain earlier, I think global monetary policy is on hold at the end of the day. It's going to be very interesting to see ultimately what the United States does later this year. Will they start to increase interest rates? Do we think they're suddenly going to slash interest rates, or do we think we're going to have a recession in the United States related to this? I think it's going to have very limited consequences for the United States, and outside of Europe, very limited consequences for countries outside that. But given the uncertainty that's been created, I think we've got monetary policy on hold, and maybe in the UK we have a rate cut in the UK. But do we see a dramatic change in the trajectory in monetary policy? No, we don't.
Thanks, Hamish.
A pleasure.
And thank you for watching. You can find more information on our website. Thanks.